are two things that you say you need to look at when looking at banks. One is loan growth, but your first pick is really not in the lending business. And the other is the normalizing of capital markets activity and merger M&A activity. Why are those the two things that you focus on as you examine banks?
Well, I think this is what's going to be changing or kind of unclear. If you look at the banks over the last, since pandemic hit, the results have been fairly stable. But what happened is when the Fed started dramatically cutting rates, net interest income fell about 12% between the first quarter and the third quarter of last year. And it's been kind of flatlining ever since then. And so it's obviously a really important question, when does that start growing again? And I actually think that that's going to happen within, the next couple of quarters. What has been holding loan growth down, as some of the stuff you mentioned, it's been the PPP forgiveness, and then also just the fact that inventory levels, across the country are non-existent. And so what's been happening is that loan volumes have been under pressure because commercial loans have been going down. All the other loans, if you take a look at all the other loan categories, they've been growing at about an 8% compound annual rate since the bottom in April of this year. So, everything's growing fine, but just the fact that nobody's got any inventory, no cars on the lot, nothing like that, has been keeping loan growth down and keeping revenue growth down. And so I would expect that to get better in the next couple of quarters.
As we head into the earnings flow here later this week, your favorites in this area are Citigroup, Bank of America, and Jefferies, which isn't really a bank per se. It's not a lending institution.
Yeah, no, I cover both banks and investment banks. And I think, the group broadly is going to benefit from that accelerating loan growth trend that I outlined. Of course, that also mirrors other activities. But, Jefferies, as you mentioned, it's kind of a special situation. They actually just had their investor day earlier today. And, Jefferies is different in that it's really a mid-cap growth company. They have been gaining share consistently, year in, year out. Richard Handler and Brian Freeman have been recruiting and adding investment bankers, during the great financial crisis when they were to be had from Baer and Lehman. They hired from Baer and Lehman. In recent years, when the Europeans were all retrenching, they hire from the Europeans. But they have just consistently been building their investment bank for years. The stock is still very cheap at 1.3 times tangible book. And, to your last guest's, point about, quality companies and quality earnings, they've got a great track record and they're wildly underfollowed on the street.